Welcome back. Well, let's find out what's happening with the local bonds and most of the global markets we track at this time. And John Mekwa, she has the details at this time, and definitely negative close for the local bonds yesterday.
Yes.
Wondering if we might see some kind of recovery.
Yeah, I guess we should have expected it because the analysts we spoke to intraday did warn us that the sentiments were looking negative, and we saw that at the close of trade where we lost more than we gained the day before. So I hope there'll be a bit of recovery today.
Right, and maybe a positive week, for close.
Positive week. Wow, I don't want to believe that far, but good afternoon, everyone. Let's just look at the market now. Let's do something a bit different. Look at the fixed income market this afternoon. So the numbers that we have are closing numbers from yesterday from federal government bonds, where there were just about 10 deals worth 11.3 billion naira, to the treasury bond, where there were 14 deals worth 8.83 billion naira, and then an OMO, that's what, of course, the central bank uses to mop up liquidity from the system. There were 13 deals, 143.51 billion naira. Let's talk about the implication of this and sentiments around this with James Adisa. James Adisa is a trader with Chapel Hill Denham. Hi, James. Good afternoon.
Hi, good afternoon. Thank you for having me on the show.
Great. So I don't know, do you have a lot of activity in the fixed income market these days?
Yeah, so there has been some activity. If you look at the primary markets, over the past 2 weeks, we've seen the central bank conduct about 3 OMO auctions. They've mopped up about 985 billion naira worth of OMO. You see, what we expect is that, with this aggressive stance from the CBN, we would see yields trend higher, and that has materialized. And we see that at the last auction, the 1-year paper was around 24%, and that means effective yields are around 31.75%. And so we've been seeing some activities, slight activities in the money market, but not so much in the bond market.
And there was the expectation that yields were going to be really low, especially for this quarter, after it does seem like the federal government has raised as much as they would have loved to, from the market, but it seems yields are still trending.
So, yeah, we expected that, the DMO's borrowing plans, when they release Q4 bond calendar, would be some form of succor for the market, given, where yields are currently. We also expect that coupon payments would also sort of douse the, trend that we're seeing. The yields trending higher, we expect that these are some of the factors that could potentially ease liquidity in the system, and that would translate to lower yields in the fixed income market. But right now, we're seeing that the central bank is really hawkish, doubling down on mopping up liquidity. We saw CRR debits to the tune of around 605 billion over last week, and system liquidity is currently in a net short position of around 700 billion. And we expect this trend to continue just because the central bank is really aggressive in, raising interest rates in order to possibly cultivate foreign portfolio investors.
All right. So what was the expectation? Do we see more aggressive interaction between the market and the government for this quarter?
So we think that, from the OMO bill side and for the money market side, given tight liquidity conditions, we might see lessen or lower activities in the fixed income market. We might not see so many trades moving through that market. But our expectations are still that, with the DMO's calendar set to, hopefully we'll see a reduced borrowing plan, and that would in turn translate to, less aggressiveness from the DMO and the CBN possibly, and that would mean that yields could moderate in the fourth quarter of the year. But, what we're seeing now is that yields are high, and if liquidity doesn't ease, we would still continue to see yields at current levels.
And unfortunately, this means more debt servicing for the government.
Yes.
Well, I don't know which way to turn now, but this obviously doesn't mean long-lasting investment into the economy, because most of them are FPIs. Before you know, they're out of it. But do we have more of local or international investors here?
The yields that are being offered in the fixed income market for savings bonds, we've seen attractive levels, and that has sort of attracted retail investors into the fixed income market. But the OMO bill, has a specific cadre of investors. So foreign investors and banks are allowed to participate in the OMO market. And we've seen that those are the yields that have really gone to the highest, about 40 basis points shy of where inflation is currently. For the NCB auction, we're expected to have one today. And our expectations are that yields will trend higher. We still think that foreign investors are very much active in this market and probably dominate the market, relative to foreign investors. But the yields that are being offered now are definitely pulling in foreign portfolio investments into the country.
We still saw that drop on the capital importation for second quarter.
Yes, exactly. And that's because we saw a slight moderation in yields also. That could partly explain why we've seen that decline in money market contribution to foreign portfolio investments by money market instruments.
Can we expect the same result for the end of Q3?
You mean in terms of foreign
importation,
trade?
Yeah, importation, capital importation.
Yes, well, in Q3, we had some of the banks carrying out their capital recapitalization exercise, and that could in turn translate to improved inflows into the country. Okay. We've also seen yields trend higher. The central bank is definitely much more hawkish in reining in inflation, and that's compelling for money market instruments, in attracting foreign investors. So our sense is that we could potentially see an uptick in capital importation in the third quarter of the year. We can't rule that out. Nevertheless, we also are aware of the fact that, we will not continue to see interest rates at these elevated levels for the longest period of time. The central bank offering high interest rates is just a stopgap. The fiscal authorities are really, the onus is really on fiscal authorities to pull in the foreign inflows that we need to sort of douse the pressure in the FX market. And one of the low-hanging fruits that we see is possibly selling some of the assets that are not being utilized efficiently. And that could in turn, pull in the capital that we need to ease the pressures that we're currently seeing in foreign exchange markets.
All right, James, thank you so much for those observations. We'll certainly be waiting for that Q3 data for capital importation. Hopefully, the banks will give us a reason to smile. But thank you so much for joining us.
Thank you for having me.
Great. All right, now let's look at other markets. That was Nigeria. Well, looking at Nigeria, but the stock market, now we see a bit of recovery. Intraday 0.04%, but we're still 96,000 right there. But this is still slim to rejoice, so let's not be so happy or get comfortable with that. In South Africa, the Johannesburg Stock Exchange is in the red, 0.56% at intraday. And then for Egypt, it's positive, 0.5%, while for Nairobi Stock Exchange is almost the same, still retaining the 108 they had about this time yesterday. We look at other markets now. I believe we'll go to the Middle East and see a red or mixed market. Dubai is red, slightly so, 0.05%. Abu Dhabi is 0.37%, hanging on to the 9,000 level. Look at other parts now in the Middle East. Tadawul is also on the flip with Qatar. So 0.03% marginal gain intraday for Qatar, while for Tadawul, Saudi Arabia is 0.53% in the red. We go to the United States now, where futures were slightly down. There you have 0.1 for Dow Jones, S&P 0.12, NASDAQ also. So slightly down for most of them, and they seem to reflect growing optimism that the Federal Reserve can navigate a soft landing, especially after last week's huge job report on Friday. But now let's go back a couple of hours with Maria Bird, our Washington correspondent. She captured the summary of trading for yesterday.
The U.S. stock market had a strong day on Tuesday as the Dow Jones was up at 0.3%, the S&P 500 up at 1%, and the heavy tech Nasdaq took a major rebound at 1.5%. As tech stocks had a great day on Tuesday, it is clear that investors are watching to see what monetary policies will come out in the next days and weeks ahead, as they're still grappling with the fact that there will not be robust interest rate cuts in the near future. Investors are also watching to see how the oil prices will be, as it seems like they've taken a retreat over the last few days. This is much hope, as the Middle East tension seems to be cooling down just a bit. Investors are also watching to see what the next days and weeks ahead will mean for the U.S. economy.
Our correspondent there, Maria Bird, sent that from Washington. Now, let's see the final market. We're looking at the Asian market. Chinese stocks sold off in a volatile day of trading. Mixed Asia-Pacific markets on Wednesday. The Nikkei is back in the green. And yes, back on the 39,000 level. I wonder when it will hit that 40. That would be a big celebration for them, yes. Kospi is in the red, 0.61%, 2,594.36. Hang Seng Index, very deep in the red, 1.38% right there. Look at other markets in Asia, Shanghai and Nifty of India, both in the red. So we see one thing with Shanghai is when they want to be green, they are very green. And when it's going to be red, it's very red. So for 2 trading sessions, we've seen very green. I think we saw 8% up and then 4% up. Then today they've decided to go the flip way, and so we see it 6.62% in the red. That's a huge fall for that market at this time. So, Ladi, I don't know if we should do something about this Shanghai. Very interesting market.
Asia is looking really, really volatile, for the past couple of days, still on the back of that stimulus they're coming into.
But I just wonder why Shanghai seems to be responding the most.
We have all those big companies there, like Samsung there. So once we also saw forward guidance for Samsung saying that they're not going to make as much, as expected for Q3 results. So all of that playing into investor sentiment.
All of that fit into this number.
All of that at this point. Thank you so much.
Yeah, thank you.
For giving us the details there. Most of these markets